do not be deterministic about anything in crypto. But if anything you're going to be deterministic on, it should be that Bitcoin trends up with time. My speculation for this market cycle all along has been that I believe it'll ultimately go to approximately $10 trillion. But I've also been pretty adamant that I don't think that it'll hit that this year. Basically, you're just sort of seeing fear and greed play out over and over again. And I think basic human emotion doesn't change.
Ben, how come no one else is talking about this stuff? Because this seems like a really great call on the market without overcomplicating it, but with sticking to some real basics that make practical sense.
I think the problem is that a lot of people just want to think about going to the moon, right? And parabolic rallies, and that's all they ever want to talk about. The more education you get, the more you realize how much stuff there is that you don't know. I want to navigate this market in a way that is a bit more rational and not full of crazy predictions that are ultimately not going to pan out. Hopefully people don't get chopped up by some of these daily movements in the market, because it's just background volatility, right? It's just background noise. We're not getting out of bed for $56,000 Bitcoin or anything like that. In the market cycle, I would argue time is on your side, but even outside of the market cycle, even if you don't trade the peaks, right? Even if you don't, in general, the cryptocurrency asset class will grow, and you can invest in it, you can help build it, do whatever, but don't get left behind. Don't ignore the cryptocurrency asset class. Don't ignore blockchain.
The world is changing. Inspiration is everywhere. It has never been so easy to connect, share, and bring people together. We're learning from others and finding the best in ourselves. Challenging our beliefs, sharing our vulnerability, overcoming our fears, transforming ourselves so we can transform the world. How far can we go?
This is London Real. I am Brian Rose. My guest today is This is London Real. I am Brian Rose. My guest today is Benjamin Cowan, the former nuclear engineer, researcher, and leading financial analyst in the cryptocurrency space. You are the founder and host of Into the Cryptoverse, a YouTube channel with over 600,000 subscribers, which provides high-quality cryptocurrency education in order to understand the metrics that are driving the market. Prior to this, you earned both a master's and PhD in nuclear engineering before working as a research assistant at NASA. You first discovered Bitcoin back in 2011 after taking a class in cryptography, and in 2017 went all in and started to analyze the data and study the market full-time. Your goal is to help investors, new and old, make sound decisions by taking a long-term investment outlook. Ben, welcome to London Real.
It's a pleasure to be here, and thank you for the great intro.
Hey, no problem. Ben, it's great having you here. I really appreciate you being here. You have a really refreshing and practical way of using the numbers to make an analysis of a market that honestly can be crazy sometimes. I spent 15 years on Wall Street, Chicago, City of London, and I've never seen a market like this in my life. Most people, I don't think, can actually even process the volatility from even a human emotional standpoint. And so today, I'm excited to have you here. And for everybody watching, we're going into the charts today. Ben's got great chart game, and we're going to be looking into charts on Bitcoin, on Ethereum, some of the altcoins, looking at flipping and all that stuff. So I'm super pumped. Maybe before we jump into it, maybe you can just start by maybe summarizing your approach to kind of technical analysis and market analysis, because it's quite unique.
Yeah, so I never really learned a lot of, say, the traditional technical analysis that most people might use. I mean, I loosely know how it works, and I understand where it comes from and whatnot. But I figured, one of the things I like about Bitcoin is it seems like a very mathematical thing. And my undergrad was in math. And I just thought that, what if there's a way to sort of mine data, mine the data for long-term trends in the market? Because the short-term stuff really can just get a lot of people to say it right. I mean, they can get wrecked, right, if they're trading things on short-term volatility in crypto. So the whole idea was, if crypto can give us these things where we can see 60% drops, 70% drops, but we're still trending up over time, is there a method to the madness? Can we sort of deconstruct what's going on here? And can we use that to try to better identify how you can make a reasonable investment in crypto while making sure you're doing it at a responsible time, and hopefully not buying the market cycle peak right before a pretty brutal bear market. So that was the whole idea behind the start of the channel, and trying to just educate people on, look, like, it can be scary at times, but if you take a look at the macro picture, we are generally on track, and we're heading to the place we've always been heading.
Yeah, I really appreciate the fact that you kind of have that refreshing approach to it, because look, I have about 500 students in my DeFi Academy, and I put them on an information diet when they start, Benjamin. Most of them are consuming way too much information, too many FOMO articles, FUD articles, too many Twitter handles with no real people behind them, and forums, and they get lost. I also tell them to get off the damn mobile phones and not stop trading at 2 a.m, and all this stuff. When I started on Wall Street in 1993, I was 22 years old. I just got an engineering degree from MIT, and they stuck me on a trading floor, and I learned how to trade from all these old school, seasoned, nasty talking, veterans. And this was back when I don't think there was an HR department, and they would just break phones. But they knew what they were doing. And Ben, I'll be honest, we didn't have a technical analysis person on the desk back then. We had a Bloomberg terminal that we could track maybe the bond future price. But, I didn't grow up with technical analysis. I grew up, with people trading the market. We had squawk boxes shouting out information. You had a floor of 300 people. You could see the FX guys yelling one day, the equity guys yelling the other day. And the whole point of that floor was to try to make sense of information and then process it. And Ben, I think these days, some people, they look at charts and they think they're a crystal ball. And some people, they think, are almost like, the people that will read their palm for them in the charts. And I don't think that's true. And that's why I find your stuff really refreshing. And I'm telling you, when people spend a couple minutes with Ben and his charts, it all of a sudden, it seems very holistic, the way you look at things. You also look at these long-term cycles as well, right? And you look at some very simple moving averages to kind of analyze things. And you start with the basics, which is Bitcoin, right?
Right. Yeah, because Bitcoin governs the entire asset class, right? I mean, if Bitcoin is generally healthy, then altcoins and things like Ethereum can do quite well. And so, yeah, there's definitely gains to be made other than in Bitcoin, but Bitcoin provides that basis to know whether the market is bullish or bearish.
Before we jump into charts, what are some of the things that we need to talk about, or just even basic assumptions for people before we jump into charts? Is there anything we should just kind of lay out, or as far as ground rules, or even something like your 21-day simple moving averages and exponential moving averages? Again, it's easy for people to get super confused and tune out on this stuff. So you don't want that, right? How do you bring people up to speed?
Yeah, I mean, I think normally the way I think about it is do not be deterministic about anything in crypto. But if anything you're going to be deterministic on, it should be that Bitcoin trends up with time, and that you have blue chips in cryptocurrency, and then you have altcoins. And then I would argue the blue chips are Bitcoin and Ethereum. Those are by far the safest plays when you think about it from a risk-adjusted return standpoint. Even if you calculate out your Sharpe ratios, your Sortino ratios and whatnot, Bitcoin and Ethereum are the blue chips. And so this is sort of the ground rules, right? Don't forsake the blue chips to go 100% micro caps. And generally get the idea that, look, the asset class is just trending higher with time. We know that if we're above the 20-week SMA, the 21-week EMA, that Bitcoin is bullish and that altcoins can run. If we're below those levels, historically, altcoins bleed against Bitcoin. Ethereum bleeds against Bitcoin when Bitcoin's below that level. When it's above, I think 5 or 6 times out of 7, Ethereum's outperformed Bitcoin when it's above the 20-week. So it's really just all about taking a few basic assumptions and then relying on those assumptions and just assuming that the general trend will just continue to play out time and time again.
Yeah, it's so refreshing to use that term blue chip. And I actually just dropped a module in my academy last week, and I used the same concept. I called Bitcoin and Ethereum like the blue chips. Then I called kind of altcoins, maybe those next top 25 market caps. And then I called what I call maybe next 100X coins, those coins that you just don't know about, that yes, will have potentially 100x returns, but also can go to zero. And then you got stable coins maybe in your portfolio, and you can break down any portfolio maybe into those 4 pieces. And it's kind of maybe a simple way of kind of looking at the market. And again, people don't know that term blue chip. It's a term that they've used on I think the stock market floor for like 80 years. And it always referred to like the IBMs, the Disneys, the AT&Ts, what back in the day was something that was almost always pay a dividend, right? Almost always would grow year on year. It wasn't necessarily a risky piece. Of course, it was an equity. It was something that, your pension fund would invest in over the years. And so for people that don't know that term, that's a way of looking at Bitcoin and Ethereum, because they have relatively less volatility than the other ones, a little bit more assurance of their network effects going forward, although everything in this space is fundamentally risky, right?
Right. Yeah, of course. Yeah. I mean, going forward, everything certainly has its risks behind it, but you could easily make the case that fundamentally Bitcoin and Ethereum are the safest plays.
And, strangely enough, Ben, almost every single guest I've had on, maybe the last 14 guests I've had on, and this could be, Dan Moorhead from Pantera Capital running 3 billion, Anthony Scaramucci, or maybe a founder of Polygon or AVAX, they're all saying, Bitcoin 10x returns over the next 5 to 7 years. We're not calling for 100x. We're not calling for 2x. And they said, again, they've almost to the person have said that. And that's what we mean by kind of a blue chip. Now, ETH, they've said similar things. Some people are more bullish on ETH, but no one here is sitting here with a straight face who's a player in the industry that's saying it's going to be 100x in 5 years. If you want those returns, you go smaller. And again, I had Dan Tapiero of 10T Holdings on last week, and he said, Brian, don't invest in my fund if you want 100x returns. That's not what we're doing here. This is a 10x return fund. Therefore, we only pay 10 times revenues and never more. I only invest in market plays, not technology plays. So he owns like Ledger and Deribit and, Animoca Brands. He doesn't do that. And he's very clear up front. And I thought that's kind of a refreshing way sometimes for people to look at things when sometimes there's a meme coin of the day that's it's easy to lose your attention, I think, in this market.
Yeah, I mean, I think the question is, would you rather have, say, like a higher probability of making like 5 or 10x, or would you rather have a very low probability of making more than that? And I think it just all depends on the risk any specific person is willing to take on. And, what's right for someone might not be right for someone else, depending on what their risk tolerance is.
Yeah, very much so. I've got some younger kids, like in their mid-20s in my academies, and they have a huge part of their portfolio in crypto. And I said, that's very high. Some of my other more senior members have a small percent. And they're like, yeah, I know that, Brian, but I'm willing to take the risk, and that's what I want to do. I'm like, okay, as long as you have that risk tolerance, but understand, what's going on. And again, it's a great way just to kind of consider, this market and the way it looks going forward. Lastly, I just want to say, 10x returns are incredible. Like when I work on Wall Street, if you said, oh, this market's only going to have a 10x return in 5 years, that's not very interesting, right, Ben? It's only in crypto where people are like, oh, that's not good enough. But for any other market in any other time in history, that's an amazing return to get on your money. And so we always have to take a deep breath and realize that even the blue chip coins have pretty stellar projected returns if you can stomach the volatility and get in at the right times. Yeah.
Well, I mean, even Bitcoin put in a 10x relatively recently from 3,800 all the way up to well over 38,000, in the span of about a year. So even the blue chips can occasionally surprise you, and still give those types of returns.
Yeah, and I think Ethereum a year ago was $400 or something like that. And I always tell my students this, and I say it 3 times with a straight face. I said, can you believe that? Something that we now use as a building block. It's like it was a tenth of the value 12 months ago. Sometimes you got to pinch yourself and remind you of where you are and what's going on. So, Ben, how should we get started today? I'm guessing you want to talk about Bitcoin and pull up a chart, but what's the best way to start this discussion?
Yeah, let me show this screen. So can you see the screen that I'm sharing right here?
Yes.
So this actually is actually the entire cryptocurrency asset class, not just Bitcoin. And the reason I like to use this one is because it more or less just shows where we are on the macro scale. You should recognize, though, that this is a logarithmic scale. So the market capitalization over here, this is a 1 trillion all the way up to 10 trillion. My speculation for this market cycle all along has been that I believe it'll ultimately go to approximately $10 trillion but I've also been pretty adamant that I don't think that it'll hit that this year. I know there's a lot of people that have kind of assumed that we'll have a market cycle peak, this year, but I would argue there's a lot of evidence to suggest that we are going, we still have a long ways to go. And I think the basis for that understanding is really looking at things like the market cycle return on investment. If you sort of subjectively take market cycle bottoms and you plot out your return on investment as a function of time, you normalize them, they'll all start on day one. There's a clear pattern here, right? And anyone can see it. Anyone has access to the data. It's just that the cycles tend to lengthen, and you also get diminishing returns. And it's really easy to understand why that happens. I mean, the cycles should have diminishing returns because, as we all know, as we just discussed, right, it's easier to see 100x gains and whatnot on micro cap cryptocurrencies in a relatively short period of time. Of course, a lot of them do end up going zero, but for Bitcoin, to see a cycle where it goes up 500x, it's just simply not going to happen anymore. It just takes exponentially more volume to move the market capitalization just another 10x and another 10x. And so the whole argument is that, lengthening cycles and diminishing returns, and diminishing returns comes from what we just said. And then lengthening cycles, you could argue that it comes from the idea that there's a lot more people every cycle. Okay, there's more people speculating, but furthermore, there's also more things to speculate on every cycle. Back in 2011, 2013, it was just sort of like, Bitcoin's going to be this peer-to-peer cryptocurrency that everyone's going to use. 2017, the narrative was more, okay, it's just a store of value. We're not going to really use it as peer-to-peer. But then you also had in 2017, you had the Ethereum ICO craze and everything that came with that. But then the problem with that back in 2017 was that all the 99% of the ICOs were just basically outright scams, to say it bluntly, right? They weren't actually focused on building something out that was actually going to, change the space. But you did have a few of them that were, and so people became pretty aware of that pretty quickly. That all right, all this stuff is we can only speculate on it for so long before we realize it's just a lot of fluff. This cycle, you have a lot more than that, right? You have DeFi. Not only that, you have institutions pouring in one after another. I mean, Tesla bought $1.5 billion worth of Bitcoin. MicroStrategy has been pretty adamant. I mean, they've been buying Bitcoin pretty constantly since like $9,000 or $10,000. And furthermore, you're going to have more institutions coming in as well. And so from a fundamental perspective, it seems like, it should take longer to reach these higher valuations, but also we would expect the returns to diminish. So we look at a chart like this.
And what chart is this? What colors are they, just in case people can't see the legend on the top?
The blue line is cycle one, okay? And you can imagine if you go back to this chart over here, this is all of crypto, but if you can imagine, this is cycle one, cycle two, cycle three, and then we're currently in cycle four. Okay. And so it looks like this. And so the whole argument is, look, like a lot of people are assuming that, and I've spent a long time debating people about this over the years. A lot of people are assuming that we're going to have a major market cycle peak in 2021 because we had one in 2017, we had one in 2013. But my argument is that, that is somewhat cherry picking data, right? Because the first cycle lasted about a year. Second one was 2.5 years. That happened to be at the end of November 2013. Third cycle happened to be December 2017, but the first cycle peaked in the summer of 2011. So I think the idea that we have to have a market cycle peak in December 2021 is basically just sort of cherry picking, one data point and saying that that's what's going to play out again. But I think as we're both fully aware, right? I mean, markets don't do generally what everyone expects them to do. Yeah. So I think you basically look at this chart and you kind of come to the conclusion that, look, like the cycle has lasted about as long as it lasted last cycle, but we should also note that there has been a discrepancy in cycle length. So I look at this and say, look, I think we're going to keep going on. I think we still have pretty clear skies as we head into 2022.
So these cycles are getting longer each time, and this current cycle hasn't hit the exponential returns of the other cycles. Is that what I'm seeing from that graph?
Sort of, yeah. And actually, one way to look at it is look at it on a linear scale. Okay. Look at the returns on a linear scale. And it fully depicts the diminishing returns we're talking about. Cycle one, 700x. Cycle two, 500x. Cycle three, over 100x. everything we've experienced this market cycle, all the ups and downs that Bitcoin has had, all the way from $3,100 to $69,000, and now we're back at 56K. It's all encapsulated in this little purple line that you can barely distinguish off the x-axis, right? You can barely even distinguish it. So what I'm sort of thinking is that at some point later this cycle, not necessarily, it does not necessarily have to play out in the next month, right? But at some point, we're probably going to have another leg, and we're gonna move back up and have one of these mania phases where we probably do have a blow off top, and then we're going to have to probably spend a couple years consolidating and building out at those prices, and then we'll likely just have another cycle after that.
Okay, let me stop you there and let me get you back on screen, because I just want to ask you, I guess, a fundamental question, Ben, is that you're tracking basically almost human behavior with these charts. I mean, you're tracking the behavior of, I guess not billions of people. I guess it's what, 150 million wallets, they say, or something, or 200 million. You're kind of tracking the psychological buying and selling habits of all these people over time, and those go into these data points. And like you said, the markets get bigger and bigger over time. And I think most people, if they took a few minutes, they would say, okay, as the market gets bigger and more players come in, we would expect less of those exponential type returns, and also maybe longer cycles or maybe other points. But can you just speak on maybe what those charts represent from like an actual human psychology perspective?
Yeah, I mean, I think basically you're just sort of seeing fear and greed play out over and over again. And I think basic human emotion doesn't change. In bear markets, people don't want to buy, right? Because it's not the cool time to buy crypto. But in the mania phases, one of the reasons you see that is because people get this idea in their head that, oh, like this thing is going to $1 million, right? Like it's just going to keep going up, and it's not coming back down. And every cycle you see that same mentality play out of, this is the new paradigm shift, right? This is the new normal. Crypto cannot fail. It cannot go down. And during those times, that's when crypto sort of makes its rounds on every single news channel, right? Every outlet, there's crypto everywhere. It just seems like everyone's buying, and you're getting calls from all your friends and whatnot, and they're buying, and that's typically the time that you have to be scaling out. I mean, it's sort of like we sort of got a glimpse of it back in April of this year. In fact, when we had that first local top of the cycle, which is very similar to what we saw in 2013. And that look like, when too much money comes in too quickly, a lot of the early investors during the bear market, right before the exponential phase where prices go up drastically, they take profits. And why shouldn't they, right? I mean, they're up 10x, 50x, sometimes 100x on some different cryptocurrencies. And you just get to the point where the market can no longer bear the selling pressure. And so we're basically just seeing that play out over and over again. And we go through periods of overvaluation and undervaluation. And ultimately, we're sort of coming to a fair value. Eventually, we're gonna get closer and closer to, I think, the fair value.
Right, and we're seeing what we believe is a long-term adoption of a better technology. And that's why we see maybe a 10x return on Bitcoin in 5 or 7 years. But in the meantime, you've got human emotions involved. And I remember when I got on Wall Street, and as I spent my career over there, you saw the Latin American debt crisis, and then the Russian ruble crisis, and then the Asian crisis, and then the mortgage crisis. And after a while, I was just like, doesn't anybody learn here? Because every 5 years, they shut the department down, everyone goes bankrupt, then they start it up again because people forgot. And that's just the cycle, not just of Wall Street, it's just humans. We're emotional creatures that think we're logical, and we try to logically, a lot of times, explain our emotional behavior in retrospect, right? And funny enough, Ben, I was running for mayor of London back in April of this year, and we were all into this campaign. I mean, it was a war out there. We had a battle bus, so I was going after all the candidates. And one of our young videographers was talking about Bitcoin, and it was at 65,000 or something. And everybody was talking about it at lunch because, of course, it was a media event. And I had an old PR guy who was in his 50s, and I joked. I said, when he buys, this thing's going to crash. And everyone laughed. And a couple weeks later, of course, it tanked because it goes into a media cycle, and then your mom hears about it, and then she buys, and then you almost know, almost somewhat predictably, that it's kind of gotten a little bit of that bubble. And for anybody who doesn't understand this gets reflected on the charts, which are basically the charts of human emotion mixed in with real technology advances. And that's why I love to see the way you just put all this in perspective. So correct me if I'm wrong, you said that it's very possible that, first of all, this cycle is longer. There's no reason it should stick to 4 years because the whole market's changed drastically. Like you said, we both had Michael Saylor on the show. He's put $7 billion of a public company balance sheet into Bitcoin. It still boggles my mind that he's done that. You got Elon Musk buying, you got institutions buying, JP Morgan likes it now, Morgan Stanley. You got potentially, 200 million wallets by the end of the year. So there's no reason to think that the cycle could change. And you think there could be another madness peak in this cycle?
Oh yeah, I think there will be. I don't think it has to be this year though. I think it's probably going to come when people don't expect it, and it could be one of those things where one of the ways I could see it playing out is because so many people think this cycle is probably going to end, or it's already ended, right? They're calling for a double top, or they think it's going to end next month. I could see, if Bitcoin continues going up in 2022, people could really start to think like this time is different. It's only ever going to go up, and lead into that mania phase. But I would argue that this time is not different. It's the same. And the same, though, is a lengthened cycle, right? That is the same, is that the cycle's lengthened. So yeah, I do think we probably will have another mania phase. And then we're probably gonna have a bear market after that, unfortunately. But then that's the time to build, right? I mean, honestly, all the real money is made in the bear market. The people that stick around in the bear market, they tend to do the best later on in the bull market. So, but yeah, I do think we will have another mania phase. It's just a matter of time.
And mania looks like $130,000 Bitcoin mid next year. Is that what kind of mania looks like, or 150,000?
Yeah, I generally think that the market cycle peak is probably between 1 to 200K is sort of like that. That was the number I gave out back when Bitcoin was trading at like $4,000. I just said, look, guys, we're probably gonna go. My number that I came up with back in 2019, I came up with 140K is sort of what I thought. But I also look at some things like risk levels on the asset class and try to figure out, well, what is theoretically possible. If I just share my screen really quick again and show you one more chart here, there's this chart, which is a chart I use to navigate the asset class. And you can see it basically color codes the price of Bitcoin from blue to red, blue being low risk, meaning that's where you really should be scaling in. And then the red would mean, historically, that's where people should probably be taking some profits, right? And recognizing that it's not sustainable.
How do you get these colors? How do you determine these colors based on?
So it's based on price, time, volatility, and basically it's also assuming we have diminishing returns as a function of time.
Okay.
I think that's a common thing that a lot of indicators out there lack, and why a lot of indicators missed the sort of the local top back in April is because they assume that what we did last time we can do this time too. But it's better to assume, in my opinion, that the returns as a function of time naturally have to diminish just because it takes exponentially more volume to move the market cap. Certainly when it was trading at 60K, I was not a popular guy for telling people that wasn't going to go to 300K this year. But look, I just stick to these risk levels. And so, when I think about like, okay, well, what's going to happen? How high could it go? It depends on when it happens, right? Like if by some a miracle we do have a peak this year and Bitcoin just goes parabolic next month, then I probably would think it's not going to go nearly as high as it could if we continue slowly moving up for 6 more months or something and then going parabolic. So a lot of it depends on when it happens, and the longer we consolidate and sort of build up to it, I think ultimately the higher we go.
Can you explain that concept to maybe people that are new to this market who want to buy the Lambo for Christmas, and explain to him that actually if we take our time and breathe and allow things to move sideways a little bit, we actually might see a higher price mid to late next year, as opposed to if we try to get there by New Year's. Can you just, because it's a really important concept that's lost on most of the market.
Well, yeah. I mean, a lot of people want to establish a position. So like institutions right now, I'm assuming there's plenty of institutions that have been establishing positions. And we know MicroStrategy has been doing it for a long time, and they have no problem buying Bitcoin, it seems, at any price, because they look at it on the macro scale. But the whole idea is that, and you can look at on-chain metrics to look at this as well, sort of like long-term holders and whatnot. People who buy, if it goes up too quickly, if we experience a return that is so attractive in the short term, we cannot pass it up, then a lot of people take profits, right? Like they want to realize those profits because we recognize that if it goes up too quickly, it's not sustainable, right? It's just simply not a sustainable move. It was not sustainable for us to go from 3,800 to 64K without having a very massive pullback that turned out to be 55%. So if we go up slowly, like if we slowly go back to 60 and then 70K, and then we work our way to 80K, then a lot of these long-term holders, we look at it and say, all right, like this seems like a sustainable move. Like, it's an organic move. People are accumulating. But what's not sustainable is when it goes up like 2x in a month or something, right? Like if we were to wake up in January and Bitcoin's traded for 150K, like I'm probably running for the hills with my profits right at that point, because I wouldn't believe that it's sustainable in the short term and that we're probably going to come back down. And then I would be looking to buy it if it comes back down. So generally, I think that's the problem, right? Like people sort of underestimate the selling pressure that comes from the people that bought when it was low. These people want to realize those gains and then book the profits and live to fight another day, rather than risking their entire investment on it continuing to go through this parabolic rally.
Yeah, really good points. And when I see markets pull off 10, 20%, I actually think this is really good. I keep an eye on it and make sure that it remains some decent support and Bitcoin stays in like those 50,000 ranges. These are really good signs. It tests, it holds. And also, I've had a bunch of DeFi people on for the past few years, from Stanley Kulichev, Aave, and the Polygon people. And they're like, Brian, I built my business in 2017 and 18 when everyone thought my market was a scam. That's all it was. And I had to put in all the hard yards. I got the developers then. And they're all saying, I'm actually looking forward to a bear market so I can actually hire somebody and build something. And again, I was in the dot-com boom startup in New York City in 99 to 01. And after 01, nobody wanted to hear about a tech stock. And guess what? That's when Google started building itself. So it's important for people to realize that this isn't monopoly money. It's not a video game. This is, real money moving to solve problems and create value. When Bitcoin goes to 130,000, that's $1 trillion more in that asset class. And that doesn't just pop in and out. Like you said, that comes from institutions, et cetera. And like you said, Michael Saylor, I think when he was on the show with me, he's like, Brian, we love Bitcoin up 250,000. Like, we're just going to keep buying that thing. And I think this is a good period now to get those institutions involved. So yeah, some really good points. Wondering if you want to jump into a Bitcoin diagram, because I love it when I look at your moving averages and just your basic candlesticks on Bitcoin. I don't know what else you want to pull up, but when
sure.
I watch even like a video you did a week ago, when you just talk about just some of the basics. And again, maybe you can explain those averages that you look at, because you don't look at a lot of other things. You look at a few basic building blocks, right?
Right. I mean, I think the most important thing is momentum. An asset that's trending up or an asset that's trending higher is more likely to keep trending higher than an asset that's not. And I like to keep it simple. I don't think we need to pull out 100 different indicators to try to make sense of what's going on, because really, I mean, no one can predict the short term, in my opinion. I mean, I think there are people certainly a lot better at it than I am, because I would be very bad at trying to accomplish predicting what's going to happen with Bitcoin in the short term. This is a common indicator that I use. I mean, it's just the 20-week SMA and the 21-week EMA.
What are we looking at here? This is a candlestick chart of Bitcoin, and what's the timeline on that axis?
Yeah, I mean, so these are weekly candles.
Okay, gotcha.
So like this capitulation over here was March of 2020,
okay.
and this was that sort of that distribution phase earlier this year, the accumulation phase, and now we're looking. I mean, what I look at when I see this is I just see we're in an uptrend, right? I mean, and by the way, like that risk metric that I just showed you, that up here is when it was flashing that dark red, right? Because it basically we were showing, look, this is not sustainable. We have to go back down, right? We have to go back down before we can go up. And then now having these periods down here, what I think it allows those, those institutions to buy, right? It allows people to secure a position at a better value. And then one of the things we talk about, the integrity of the bull market, is the bull market the integrity is sustained as long as we hold the bull market support band. This is a combination of the 20-week simple moving average and the 21-week exponential moving average.
And
right?
which colors are those on the screen? Those yellow is the simple moving average?
Yeah, so the red one is the simple, the 20-week,
okay.
And then the green, yellow, whatever is the 21-week EMA.
Okay.
And you can see, I mean, if we switch this over to the daily time frame, you can see that the 20 week is, I mean, that's exactly where we held the line, right? I mean, that was the point. And this is what we said for years, that look, until it, like, so back over here, one of the things I said was, look, we're probably going to break out up here at some point and get above the bull market scorpion. That's not the hard part, right? That's not the hard part. We can break above it all the time. We've broken above it before, and we fail to hold it as support. If we fail to hold it as support, we have to kick the can down the road a few months, right? We've seen that happen many times.
Right.
But if we hold it as support, which is what we did, then we should be able to put in a new all-time high. It's the same thing that happened back over here in August and September of 2020. We moved up, and then we came back down, tested our support, and then we were off to the races, right?
Right.
So I would argue, look, same thing happened today. We came from below at this time, above it. September historically is a bad month. On average, Bitcoin loses approximately 6 or 7% of its value in September. There is some recency bias to the idea that it always does bad in September, but it has done bad in September for the last 5 years straight. And so, you know, I looked at that and said, look, guys, we need to test this before we move higher, before we can put a new all-time high. We tested it, we put a new all-time high, and now we're actually getting close to it again. And you could argue that there's a distinct possibility. I don't know. I mean, I'm not necessarily counting on it to test it. I have my Bitcoin position regardless. But you know, you go back and look at 2017, and you can see every single time that Bitcoin came back down to that 20-week moving average. That is where we kept holding the line, and every time we held the line, we would then go put in a new all-time high. Mm-hmm. Okay, so the whole idea is, as long as we hold it, then we can keep. You know, we hold it, we move higher. We hold it, we move higher. But if we go look at the short-term risk on this, so this is the extension from the 20-week, in 2017, we never got too far extended from the 20-week SMA, right? You can see it wasn't that far extended down here, and we held the line every single time. Once we had this,
it went too high.
We went too high.
Right.
We could not sustain it, right? We just simply could not sustain it. Again, look over here in earlier this year, we went too high. We could not sustain it. But when we only came up this far, what happened, right? We held the line at the 20-week. So what I'm looking for is, I'm like, there's no guarantees, right? There's no guarantees in life. Of course, we could always go back below it. But I would say there's a much higher probability that we hold it as long as we don't get too far extended from it, right? If we come back up here, then, you know, we're likely, it's just too far extended. We're not going to be able to sustain it. And then we have to go back down for a while.
Yeah. Very good analysis. And right now, where are we with Bitcoin? Are we just hanging near those 21-week averages, or not even close to those right now?
Yeah, so they currently, those values currently for Bitcoin are ranging from around 50.7K up to 52.7K. So basically just think about it like, you know, like 51 to 53K, more or less, is where we would like to stay above. Those are weekly time frames. We can always have wicks below. You know, no one's getting out of bed for a wick. It's more so, what are the weekly candles doing? Are we holding the line above it? And if we are, then we should stay relatively healthy. And that's why, right, Ethereum has been doing really well, right? I mean, Ethereum continues to do well. And most of the time when Bitcoin's above the 20-week, Ethereum outperforms Bitcoin until Bitcoin gets back below the 20-week. But every single time Bitcoin has been below the 20-week moving average, every time in history, anytime it goes below the 20-week, Bitcoin has always outperformed Ethereum up until it gets back above the 20-week later on. So every single time. So if historically, every time Bitcoin dropped below the 20-week, you just sort of thought to yourself, all right, my expectations are that Bitcoin will temporarily outperform Ethereum. You'd be right, like 6 out of 6 or 7 out of 7 times at this point.
Right.
So it's just something to consider, right? But if we're above it, like we are now, then, you know, you'll see Ethereum's going to continue to do well, right? I mean, it still looks incredibly strong.
It's almost like that concept I think they use called beta when it comes to, you know, stock markets, where there's like a bellwether, which is like Bitcoin. And when it's doing well, you've got things that have higher multiples that'll do well along with it. So in a market rally, back in the day, it was the tech stocks and the .coms that would do really well. But if the blue chips were down, the better bet was to hold those blue chips, because the high beta stuff was just going to get crushed. And I think you're saying a similar thing here, right? When Bitcoin's above its moving average, you can get a leveraged return maybe in Ethereum and some of the other altcoins we'll talk about. But as soon as it goes below, those things are going to start getting magnified losses. So that's when you potentially want to get your money into Bitcoin, those blue chips, or maybe even to stablecoin if it pops as high as, like you said, 150,000 by Christmas, maybe it's time to run for the hills for a little while because the emotion's gone a little bit crazy. Am I summarizing that okay?
Yeah. And yeah, like I certainly don't expect 150K by Christmas, but you're right. If it were there by Christmas, I would be running for the hills. I think the better way to navigate crypto is sort of just a bunch of if-then statements, right? If this happens, then that. We all like to make predictions on what's going to happen, but I think the better way is just say, if X, then Y.
And also, the longer we stay lower, the average kind of gets closer to where we are. So if Bitcoin stays now in this mid-50s range for another 3 months, that average will be starting to be crossed soon. I mean, you also don't want to stay low too long, right?
Right, but we could stay here for months potentially before it would realistically catch up. Because I mean, we could probably be here for 2 months and we're still just above it. I mean, because if it's a function of the last 20 weeks or 21 weeks for the EMA as well. And so if we're sort of just hanging on at these prices that are just above it, I mean, historically, that's been really one of the best times to buy Bitcoin if it holds. I mean, obviously, there's a huge if there, but that's the risk you take, right? I mean, no one really fully knows if it's going to hold. We didn't know that it was going to hold in September, but we did say that if it does hold, and there's a reasonable chance it does, considering that we think the cycle is going to lengthen, right? I mean, we're sort of taking this market cycle theory stuff and saying, look, we don't think the cycle's over. We do think Bitcoin's going to keep trending higher with time. Therefore, there is a good probability here that we are not heading into a 1 to 2 year bear market, but that we just had a 3 to 6 month lull in the market. We need to hold the line at the 20-week, and then we should be off to the races. And, so far, this cycle, from what I can tell, the first half of this cycle looks like 2013, the first leg of 2013. It's certainly possible that the second half of this cycle emulates what happened in 2017, right? Where it just sort of goes above the 20-week, 30, 40%, and then comes back down to hold it as support. And we just keep doing that for a while.
And if it drops below 50 and stays there for a week or two, you become alarmed because then that's breaking that SMA.
Yeah, I mean, the problem with it going below those values are that altcoins bleed. We know that altcoins bleed against the US dollar if Bitcoin's going down, but the more important thing is that they're going to bleed against Bitcoin, right? So at that point, it's like, do you really want to sit on extremely large altcoin positions if someone's like 90% altcoins, which they shouldn't be, I don't think, but if you were like 100% altcoins or something, you have to look at the data and say, look, when Bitcoin's below the 20-week SMA, altcoins get absolutely destroyed against Bitcoin during that phase. We've seen it happen plenty of times in the past. And so that's sort of like what the alarming thing you want to look out for. If that happens, then be careful with altcoins.
Yeah. And this is all a way of almost like quantifying groupthink, right? As a human psychology species. Like it's weird. That's kind of what you're trying to quantify and predict and model, really, Ben. And it kind of might make sense when you explain this. Ben, how come no one else is talking about this stuff? Because this seems like a really great call on the market without overcomplicating it, but with sticking to some real basics that make practical sense.
Yeah, I don't really know. I mean, I know. I'm sure there are some people that talk about this stuff, but I think the problem is that a lot of people just want to think about, going to the moon, right? And parabolic rallies, and that's all they ever want to talk about. But really, and I also think people want to assume that they know exactly what's going to happen, right? Like it gives them a sort of that confidence that they say, all right, it's going to peak in December, and then we're going to go down. Then we're just going to keep rinsing and repeating the same thing every 4 years for forever. I just don't think that makes a lot of sense. I think one of the things is, the more education you get, the more you realize how much stuff there is that you don't know, right? It's not, I feel like the more educated I got, I was just like, all right, like I just feel dumber and dumber because I just realize all these things in this world that I just don't have any clues about. I look at crypto and I look at Bitcoin. I want to respect it, right? I don't want to assume that I know exactly what's going to happen. I don't want to assume that it's going to go parabolic tomorrow because, you can get burned if you think that. But the point is recognize some of the key areas of support. You can mine all of this with, just simple.
To continue watching the rest of the episode for free, visit our website londonreal.tv or click the link in the description below.